Welcome to our educational podcast, where we delve into essential topics that shape our understanding of the world. We're dedicated to empowering students like you with the knowledge that can help you navigate life's financial choices. Today, we're exploring the exciting world of risk, investing, and decision making. Whether you're just starting to learn about finances or looking to deepen your understanding, this episode is for you. Subscribe now to keep learning with us and join our community of curious minds. Let's dive into the first concept, risk. When you invest, you're essentially taking a chance in the hopes of earning a profit. However, with every investment comes uncertainty. Risk is defined as the possibility of losing all or some of your investment. The link between risk and reward is crucial. Generally, investments that promise higher returns also come with higher risks. Conversely, safer investments might yield lower returns. This is significant to understand if you're keen on navigating the investment landscape effectively. Investing itself is the process of allocating your resources, usually money, with the aim of generating income or profit. Making informed decisions in investing means analyzing various investment options based on your risk tolerance, your financial goals, and your timeline for needing the funds. There are several different types of investment risks that investors should be aware of. Market risk pertains to the chance that the overall market will decline, impacting all investments negatively. Then there's inflation risk. This is the risk that inflation might erode your purchasing power over time. Interest rate risk is crucial for fixed income investments, as rising rates can lead to declining values. Credit risk concerns loans where a borrower may default, while liquidity risk relates to your ability to quickly sell an investment without losing value. Currency risk affects international investments based on changes in exchange rates, and concentration risk happens when too much money is tied up in one investment. By understanding these risks, you can evaluate potential investments more comprehensively and build a diversified portfolio. Speaking of which, let's discuss diversification. Diversification is the practice of spreading investments across various assets to minimize risk. The adage, "don't put all your eggs in one basket," encapsulates this concept well. Different assets can perform variably under different economic conditions. For instance, if one asset class falters, another may thrive. This strategy encourages diversification across asset classes, like stocks and bonds, sectors such as tech and healthcare, and geographies that might include both domestic and international investments. Diversifying can help reduce the impact of a single investment's downfall on your overall portfolio. Proper diversification can mitigate risks while maintaining returns, making it one of the few free lunches in investing. Now, let's look at the risk-return trade-off, which teaches us that the potential return on an investment usually rises alongside an increase in risk. For example, low-risk investments like government bonds are safe but yield modest returns. Moderate risk investments, such as corporate bonds and blue-chip stocks, can offer better returns, while high-risk investments like small-cap stocks or startups may promise the greatest returns with a significant chance of loss. For younger investors, risk tolerance is often higher due to a more extended time horizon for recovery, while those nearing retirement may prefer safer options to protect their savings. A critical aspect in this risk equation is understanding your personal risk tolerance, which is your ability and willingness to accept risk in your investments. Factors influencing this include age, income stability, financial obligations, investment goals, and even your personality. Younger individuals may take on more risk due to their longer timeline for potential recovery, while those with more significant obligations might lean towards safer investments. To determine your risk tolerance, consider taking a questionnaire that assesses your ability to handle market fluctuations without panicking. Remember, as your life circumstances change, so might your risk tolerance. That brings us to time horizons, which is a term used to describe the duration before you need access to your invested funds. The time you plan to invest is incredibly important when deciding on your investment strategy. Long-term investors, for example, generally face less pressure from market volatility than those with a shorter time frame, as they have the luxury of time to recover lost ground. Historically, markets tend to rebound and grow over longer periods, which means that being able to ride out downturns can lead to considerable benefits for those who invest wisely early on. Now, let's discuss making informed investment decisions. Informed decisions start with research, analysis, and critical thinking. Knowing what you're investing in is key. You should read up on prospectuses, understand the associated risks, consider costs, and evaluate taxes. Always weigh your alternatives and be wary of letting emotions, like fear and greed, influence your decisions. These can often lead to poor choices. Many seasoned investors recommend systematic investing, consistently putting money into investments regardless of market conditions, because it often yields better results than trying to time the market. Learning how to make informed decisions helps you to avoid common investment pitfalls. Moving on, even seasoned investors can err. Some common mistakes include trying to time the market, which is notoriously difficult, chasing past performance, an act that often leads to buying high, and failing to diversify their investments. Emotional investing, such as panicking during downturns or being overly enthusiastic during booms, can lead to catastrophic financial decisions. Checking investments too frequently can cause unnecessary stress, as can paying steep fees, which can hamper returns over time. Following a solid plan and maintaining discipline while steering clear of these errors is crucial for successful investing. Those who truly excel at investing tend to be more focused on solid habits and well-thought-out plans rather than simply trying to pick the hottest stocks. Lastly, we can't overlook the role of compounding in investing. Compounding occurs when your investment earnings generate further earnings, allowing for exponential growth as time progresses. When you reinvest your returns, you create a snowball effect, where your money works to earn even more money. The key here is time. The longer you allow your money to compound, the greater your returns can be. For instance, if you invest just a few $1,000s at a modest interest rate for several decades, you can end up with far more than you initially put in, thanks to the power of compounding. Getting started as early as possible is crucial. This brings us to building a sound investment approach, which starts with understanding that risk and reward are linked. Get to know your risk tolerance, diversify accordingly, match your investments to your time horizon, make informed decisions, and remember to harness the potential of compounding. Consistency in your investment strategy can help you navigate through the complexities of financial markets. Investing is indeed a journey that requires patience, learning, and persistence. The most successful investors are those who embrace these principles, keeping their eyes on the long-term goals rather than getting swayed by short-term market fluctuations. With a solid foundation of knowledge about risk, decision-making, and investing, you can empower yourself to achieve your financial goals over time. In this episode, we explored the critical concepts of risk, investing, and decision-making. We learned about the inherent risk in every investment and the importance of understanding the risk-return trade-off. We discussed key factors like risk tolerance and the benefits of diversification to minimize those risks. We also examined how time horizons impact investment strategies and the remarkable power of compounding over time. Remember, a successful investment approach is built on informed decision-making, discipline, and an understanding of personal financial goals. By integrating these principles, you're in a stronger position to build wealth and secure your financial future. Thank you for joining us on this educational journey through the world of risk and investing. We hope you found today's lesson informative and empowering. If you enjoyed this episode, please subscribe, share it with fellow learners, and continue exploring the world of finance with us. Until next time, stay curious and keep learning about the principles that will shape your future.